Hello, everyone, and welcome, and thank you for joining us for our Q4 2023 market update call. Unlike the last one we did, we're going to kind of go back with the format since John is here as well. So we're going to kick it off with him. He's going to kind of discuss where we've been, what we're seeing today in the data, and what to kind of be expecting here in the near and long-term future here. Then we'll kick it over to Jason. He has quite a few slides we want to just kind of touch back on and kind of reiterate, kind of what we're seeing, what you're seeing in your accounts. And then, of course, we're going to open that up to questions at the end. For the participants that are here that are live, there's that chat feature. So if you do hit the chat at the bottom of your screen, it should open up the window on the right-hand side. Any questions that you might have right now, while we're discussing and bringing up our points, or anything on your mind, go ahead and put that in there. I'll either be, chatting that back to you during the presentation, or at the end, like I said, those questions will come up and we'll discuss further at that point. So at that, juncture, John, why don't you take on over?
Okay, thank you, Michael. So I'm going to start like I typically do. I'll look at the last 3 months and we'll compare how we did by month compared to the markets, and a 60-40 allocation, which is probably 60% equity, 40% bonds, which is more in line with our allocation. Then I'm going to go through what our current allocation is. I'm going to touch briefly on gold, and then I'm going to also spend a decent amount of time talking about what we're seeing. And then finally, I had a couple of questions that came to me from clients, so I'll address those at the end of my talk. So let's start with the basics. Let's start with performance. So let's go to July. So in July, we were up net of fees 1.25%. The 60-40 allocation, which kind of falls more in line with our allocation, was up about 2%, and the S&P was up 2.8. In August, the market, we were down 1.3, the S&P was down 1.3, and that 60-40 allocation was down 1.44%. And in September, we had a really good month. We were actually up about 0.5%, just under. The S&P was down 5%, and the 60-40 allocation was down around 4%. So for the overall quarter, both the S&P and the 60-40 allocation that we look at were down about. Well, we basically outperformed those markets by about 4%. And most of that obviously came in September, when markets had a pretty rough time and we actually made money or were flat. So net, we've made up 4% of our underperformance, 4.5% of our underperformance in this last quarter. So that's good, right? Because obviously we all know we started off on the wrong footing. We were too short. Market decided to rally, yada, yada, yada. So we think we're now in a place where this market's going to get brutal, and I'll talk about that in a little bit. And so there may be more instances like September where the market is down 5% and we're up, 1 or 0.5% or whatever. I think we may see more of those months going forward. So that was performance. Once again, to summarize, we outperformed by 4 to 4.5% on that quarter. Our current allocation is very interesting, and it's something you don't see very often, but we haven't had this opportunity in decades. So short-term interest rates, T-bill or Treasury bill rates, or U.S. government rates for 6, 12-month maturities are in the 5.5% range. We haven't seen that in decades. So all of a sudden, the stock market has a competition called the bond market, and the short-term bond market, really, all right, the 1 year or less maturities. So currently, if you look at your accounts, you got something that has a symbol of TVIO, another one is TFLO, another one's SHV, and then you also have individual treasury bills. Those are all the same thing, basically. They're different vehicles that invest in treasury bills maturing in less than a year. So most of us have about 75% of our portfolio in this allocation. I haven't done this since, frankly, 2008 was the last time I was allocated this way, right before the crash. So the beauty of this is that they're now producing 5.5% returns with no risk, basically, right? If those things don't pay out, then your dollars won't be worth anything anyway. So they're the safest asset in the markets, and they're yielding 5.5%. So if we do nothing in the next 12 months and just hold on to those 75% allocation, those T-bills, that alone will produce about almost a 4% return on an annualized basis. So what this is doing is massively stabilizing our portfolios, producing nice current income, and we're trying to get additional returns off the other 25% that we're managing more actively. So if you look at, so we'll call it 75% treasury bills, we're short about 10% between the three different shorts that short the S&P 500, the NASDAQ, and the Russell 2000. And we're also short junk bonds. So if you add all those up, it adds up to about 10%. And we're going to get very aggressive shorting junk bonds or high yield debt. Those things haven't collapsed yet. And when they do, there's nothing better to make money. And you make it in a very short period of time. And we think that's just about to start happening. We also have about 4 to 5% exposure in uranium, oil, something called CTA, PFIX, which is an interest rate. We make money if rates go up. And we have about 4 or 5% in the US dollar. So that kind of summarize our allocation. So we're allocated for very difficult periods, hence the reason we made money in September. And we do, well, I'll talk about this in a minute. So that's a current allocation. If you notice that your allocation a couple of months ago, you had about 20% between gold, silver, and miners. Today you have none. Historically, no different than 08, you would expect gold to go crazy in an environment like this, right? You've got inflation running, you got 2 wars now going on, right? One in Ukraine, one in Israel. You've got government shutdown looming. You've got massive debts. I mean, our deficits this year are going to be close to 2 trillion. Think about that. Government deficit of 2 trillion, and gold's not moving. It's going down. A lot that happened in 08 too, guys. Even though it makes total fundamental sense to own a lot of it, it's going down. Why? Because it's looking at interest rates. Interest rates are rising, gold's going down. Those two kind of are yin and yang. In 08, the same thing happened, and gold finally took off in 08 after the stock market, the S&P 500, literally crashed. I suspect that we're going to see a similar outcome here. We're out of gold. We're watching. If and when this thing really implodes, my guess is gold's going to finally find a bottom, a real bottom, and then it's off to the races. In 08, the only things that were up were cash, treasuries, bonds, and gold. So we're patiently looking, and we don't want to take loss on gold while we wait. All right, so what are we seeing? I'm just going to talk about the big stuff we're seeing. China and Europe are already in recession. We're entering recession this quarter. Our data is telling us that we're entering recession as we speak. We've got at least 9 months, 3 quarters of quad 3, quad 4, which is effectively a recessionary environment. In a typical recession, stocks drop 20 to 50%. So that could be straight in front of us. Yeah, last year markets were down 20-some percent, 25, 26% on that 60-40 allocation. We could be down that much more, a lot more, in the next 9 months, depending on how this recession plays out. So we're definitely in recession, in our opinion, and so is pretty much the rest of the world, or a good chunk of it. Inflation is reaccelerated. So you're watching oil going back up. I think orange juice an all-time high. Butter hit an all-time high yesterday. So you're starting to see a lot of inflation creeping back. When you step back and look at this market, 7 stocks are holding up this whole Ponzi scheme. So your Apple, Microsoft, NVIDIA, Google, Meta, Tesla, those stocks, are Amazon. Those 7 stocks had a market value of 12 trillion a month and a half, 2 months ago. Today it's down to 11 trillion. Those 7 stocks is where everybody's piled into. No different than 2000 and 2008. They all pile into the same names, and then once those names go, everything goes. 5 of those 7 names have broken what we call trade and trend. So they're bearish from our technical standpoint. So there's only 2 left of those 7 that technically are still strong. So that edifice of, that pyramid's starting to crumble. My guess is sometime in the next 1 to 2, 3 months, those things are going to start imploding too, and then it's game over for the markets. Now, the thing that we're really, really focused on is whether or not the Federal Reserve has lost control of the bond market. I've been looking at this for 23 years now, wondering when it's going to happen. By that, I mean interest rates are rising in spite of the Fed not wanting to raise rates. That happened 3 weeks ago. The Federal Reserve came out and said, oh, you know, we think inflation's under control, which is total bullshit. He was lying. But interest rates didn't come down that day. They went straight up and have been going up since, for the most part, up until recently. So if the Federal Reserve loses control of interest rates, that means interest rates can keep climbing irrespective of what the economy is doing. In an indebted economy like ours, and frankly worldwide, that's a kiss of death for most equity markets. So we're watching that very carefully, because if we are entering what I call a funding crisis, which is what's the term for losing control of the bond markets, i.e. interest rates go up irrespective of whatever you do, it's a different game. So we're watching it closely. We think it's real, and it's making us very nervous. It's frankly one of the reasons why you're sitting on so many treasury bills. So that's kind of the sum of what I want to talk about. I did get asked 2 questions, so I'm going to answer them now. The first question was, why is silver not taken off with all the uses of it and electric vehicles and what solar panels and all that? Why isn't it taken off? Well, good question. Silver most of the time behaves as a commodity. When something behaves as a commodity, it's basically priced at a marginal price of producing it plus a small spread, right? Margin. So the produced gold plus or minus takes about $20 an ounce, and guess where it's trading at? About 20, 21 an ounce. Now, when silver takes off, when it becomes viewed as a currency, not as a commodity, that happens very rarely, but it does happen, and it usually happens for a fairly short period of time. In both instances that silver hit $50 an ounce, it was because the market was repricing it as a currency. It's not there today, right? We're not even in gold. So silver is effectively behaving like a commodity. At some point, my guess is in the next 3, 6, 9 months, it'll start behaving more as a currency, and then you can really see the upside to it. For now, I'd rather short it than go long, frankly. So we have no position in it. The second question I got was basically asking me if we knew anything about integral fast reactors. And the premise there, or I think behind the question was, hey, we got an energy issue potentially. Nuclear seems to be a really good solution. You know, why aren't these small reactors proliferating? And I think they will. Frankly, I think that is the solution to energy crisis, these micro nuclear reactors. They're already in existence. The technology exists. The Canadians are really good at it. The Chinese are really good at it. These are small nuclear reactors that literally you can fund small cities. You have a 100,000 person city, you plop in one of these little reactors. They're no more bigger than, frankly, a semi rig, and you can really, light up the entire city very quickly, very cheaply, very economically, very environmentally friendly for the most part. So in terms of those reactors, why haven't they caught on? My guess is like anything else, you got lobbyists, right? So you got the oil lobby, the natural gas lobby, the solar power lobby, the wind turbine lobbies, and the nuclear guys may not be as strong a lobby for now. So it's all about politics at this point. So that's my guess. At some point, even the politics won't be able to stop these things from being used. And as you've noticed, we do have nuclear. We do have investments in nuclear. Nuclear could be a really interesting investment for going forward. It may behave very differently than oil because there's serious supply-demand issues. So on that, I'm done, and I'll turn it over to Michael.
All right, appreciate that here. Just a reminder once again, that chat feature, if anything popped up, question-wise, feel free to type that in. And then with Jason here, you want me to go ahead and share my screen for you?
Yeah, can you hear me okay?
I can.
John, that was really good. I actually learned more about nuclear reactors than I think I ever have in my life. So nice work, man. All right. So,
Sorry, I was mute. I said I aim to please everybody.
all right. So what we're going to do, we're going to, go through some slides that we've gone through before, but I think it's important at this time to go through some really basic understanding of how we look at the market, what type of economy we're in, and what type of economic environment we're going into. So this is a slide. You'll notice on the right that we have a sine curve. And so this sine curve depicts a full investment cycle. And our firm invests assets based on a full investing cycle and pits it against what John had mentioned, other benchmarks such as a 60-40 portfolio. So we believe a lot of investors get stuck on the year-to-date performance. I get it. That's how Wall Street works. Whereas the true metric that all investors should look at is really cycle-to-date performance. So if we take a look at this sine curve on the right, our current position is located on the downslope of the curve. And so think of the current economy being at the midpoint of the downslope. As such, we haven't really hit the trough of this cycle quite yet. There is more downside to come, as John had mentioned. The top of the sine curve occurred in November of 21. And as such, we're nearly 2 years into the cycle. To put some context into the performance of US indices cycle to date, the Russell 2000 is down about 28.5%. NASDAQ's down about 16.4%, and the S&P 500 is down 10.2%. One other quick note about year-to-date performance, and John had touched on this, but to get a little deeper into it, 90% of the S&P 500's year-to-date performance is in 7 stocks, and only 33 of the stocks in the S&P 500 are beating the S&P year-to-date. So pretty drastic numbers.
Hey, Jason, do you have the cycle to date returns on bonds since 2020?
I think I do. I wrote it down. While I'm going through these, it'll probably pop into my head, but I know it's the last 3 years. I can tell you that bonds are down over 40%.
Right. Yeah, it's brutal. Yeah.
Yeah. So that, and I'm going to hit on that, but the 60-40 portfolio, for all those that it's worked so well in the past couple decades, or we'll call it 25 years. I'm not sure that's going to be the case going forward. And I'll explain a little bit about why. But yeah, I believe, John, long durations bonds as a proxy, TLT is down over 40% in the last 3 years. So slide 6. So this is our quad map and where we're projecting the next 3 quarters out. And as you'll notice, our data is placing our projections between a quad 3 and quad 4 environment, as John had mentioned. As we move through time, the quad we ultimately land in will become more apparent as we get more data. But either way, the next 3 quarters will be a very difficult environment to be long equities. Slide 12. So in this slide, we wanted to provide a little insight into what Tier 1 is providing to Hedgeye and why they implement their data into the process. What I want you to really focus on is the flip line. And without getting too much into detail, this data is coming from the options market. The flip line in this chart is calling out the number 4443 on the S&P 500. As such, if the S&P 500 trades above the flip line, what you'll see is decreased volatility and more buying from dealers, CTAs, and other volatility trading shops. And this will push the market higher. This is what we were missing at the beginning of the year. The reverse is also true. If the market breaks below that 4443 area, volatility will increase along with selling pressure. And we receive this data daily, and it helps us to position the portfolios appropriately. It's a big reason why we reduced equity risk in portfolios before the most recent breakdown. Slide 17. So this GDP chart is the growth part of our GIP model. GIP is growth inflation policy model. We project where GDP will be in a few quarters out. It allows us to probability weight the type of an economic environment we will go into. And as you'll notice, we expect the third quarter GDP to stay relatively constant and then break down over the next 3 quarters nearing the 0 line. So on a year-over-year basis, growth will break down starting in the 4th quarter of this year. Slide 19. And then GDP on a quarter-over-quarter basis looks even worse. As you'll notice, we have a slight uptick in the 3rd quarter, but then GDP drops negative on a quarter-over-quarter basis. So slide 20, inflation. This is inflation on a year-over-year basis. It peaked in the second quarter of 2022 at 8.63% and broke down from there, but we are still at elevated levels. In fact, we see a slight increase to CPI over the next 3 quarters. Slide 22. So this is a new chart that we wanted to show. This is headline CPI, and it's shown monthly. And as you'll notice, July had a slight uptick, which was unexpected by Wall Street, but we actually called it out prior to the numbers. So CPI inflation is going to stay elevated for longer than people expect. This chart gives a nice cartoon example of where the US economy is at the present time in cycle terms. Excuse me, as we talked about on the sine curve slide. Slide 41. All right, we've had 7 months of negative revision to the employment numbers. And this is important because the last time that happened was during the great financial crisis. Next slide. The last 3 years has seen negative returns for TLT or long duration bonds. So all of those 60-40 portfolios that I mentioned that hold about 40% of their portfolio in bond allocations are getting destroyed. Slide 64, this is basically just kind of reiterating government shutdowns are rarely a good thing for market returns. Currently, the Kalshi markets, KALSHI markets, has the odds of a government shutdown at a very, very high 82%. The odds of a shutdown lasting more than 77 days is 76%. And so protracted shutdowns produce all manners of distortions in the interpretation and the production of macro data. The chart on the right shows the S&P 500 returns versus government shutdowns in the red. Slide 76 is the UAW strike. This strike could promote massive economic loss statistics nearing 500 to 600 million per day in dollar terms. Look what happened to transportation equipment manufacturing during the UAW strike back in 2019. UAW really isn't the only organization striking or looking to strike either. So there's going to be more. On September 30th of 2023, the $24 billion child care funding program expired. This is another program that pushed liquidity into the system and is now being extracted. The FFCRA program that enhanced Medicaid funding ended in March of 2023 of this year. And over the next 8 months has an estimated 8 to 24 million people that are set to lose coverage. So again, more liquidity is being extracted from the economy. And don't forget about the EIDL loans that the government dispersed through the SBA during the pandemic. Repayment of those loans began in 22, but are set to ramp up in 23 and 24 unless Congress approves some type of forgiveness. These are going to need to be paid back right when Americans are not in good shape. Slide 79. And I think the big question is how hard will it hit the fan? Well, if you look at these, if you look at this slide, delinquencies are rising on auto loans and credit cards. But what about student loans? Student loan repayments will have a hugely negative impact on family discretionary spending. And interest payments are taking a larger and larger portion of discretionary spending. Interest payments are growing faster than interest income, which is a net negative for household revenue. Without the ability of households to refinance their primary residence to pay off debt and overcome other household expenses, Americans are now relying on 401k hardship withdrawals in order to pay for the usual household expenses. And as I mentioned, cash out refis are non-existent. That game is over for now. In slide 108, excuse me, let's not forget about the federal debt load. And John touched on this of $32.3 trillion in 23. 26 trillion of that is held by the public at large. Slide 110. Government spending was the hero in the first quarter of 23. This was the impetus for the US equity rip in January, February, and really what we failed to take into account on a more meaningful basis. So I wanted to take a moment to really look at this infamous, or I'll call it famous, Inflation Reduction Act and what it's done to federal spending. At first, it kind of remained a mystery. It's now 2 to 3 times their estimates at $663 billion. So this is just in the past 12 months. Even at that price point, it doesn't move the needle much on US gross GDP. It basically equals 15 basis points of growth, whereas student loan payments will reduce that growth by 74 basis points. So realistically, this Inflation Reduction Act is an absolute failure on every level. That's the last slide, but I wanted to kind of touch on something that John had mentioned on the 60-40 portfolio composition, because I heard a great conversation related to this investment idea from Jim Bianco. And the big thing for them is that this static asset allocation portfolio is what most wealth management funds rely on for their business. And for the past 25 years, this portfolio has worked because we were in a period of low inflation. Inflationary periods like we're in right now destroy 60-40 portfolios. The idea behind a 60-40 portfolio is that when things get ugly on the equity side, the bond allocation will rally. But when you have periods of inflation, example like the 1980s, bonds perform poorly. So rates go up, bond prices go down, and these 60-40 allocations get destroyed. If we have a higher for longer rate scenario where the stock market is competing with a 5.5% treasury bill, these wealth management firms are going to get wiped off the planet unless they change the way they manage money. These static asset allocations don't have a chance in today's market or possibly tomorrow's new market. The mid 2020s and late 2020s are going to be a very different beast. And so my point is professional active asset management is going to be the buffer against these negative bond returns. A couple other points that I want to call out that maybe might give you some sense of when I talk about liquidity, why it's important, liquidity in the market, central banks putting liquidity out in the market, so on and so forth. The fact is we have a lot of negative data right now, geopolitical events and global stock market returns. Global liquidity tends to front run the direction of the global stock market returns. So if global liquidity starts to decrease, the typical effect is a breakdown in global stock market returns. The other side is if global liquidity increases, global stock market returns tend to have a positive correlation. So these massive government programs that poured liquidity into the system would push many global stock markets higher. Now these programs are ending. We have liquidity being extracted from the economy and pushing the global stock markets lower. It's also why we have GDP or growth slowing. Liquidity is being extracted. So this will end in a recession, but our job is to risk manage this market up until and during the recession. And that's really all I have for you, Michael.
Jason, I had one quick thing. You brought up massive amount of deficit spending this year. Just to give folks an idea, because I know you folks have been listening to us and saying, well, you guys were kind of talking like this last year. But yet here we are. I mean, the Federal Reserve or the Treasury printed $275 billion of additional debt this past weekend. Mm-hmm. These guys are literally printing trillions to try to keep this economy from totally imploding before the election. Mm-hmm. They did it with the Strategic Petroleum Reserve, where they basically sold off more than half of it, right? It's going to take us 40 years to rebuild that Strategic Petroleum Reserve. These numbnuts drained half of it to try to keep oil prices, gasoline prices lower. They've also run multi-trillion-dollar deficits this year. I mean, if you look at the employment data, it's all government employees. They're hiring, everybody else firing.
Right.
So the magnitude of the manipulation that we're currently seeing is off the charts. And it really, when we get to the other side of this, oh my God, I'm not sure where you run, because they're throwing everything at it. Very, 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 very incredibly dangerous way to run an economy. And it sets you up for total failure and collapse at some point if you continue to do this.
Yeah, and to be honest, John, I think you and I agree on this, but the Fed has no idea what the hell they're doing. They have no idea how they're going to get themselves out of this. I don't know a way. I think you and I have talked about this numerous times on how in the world the Federal Reserve produces a soft landing. And to be honest with you, that soft landing isn't what everybody is going to need, because a soft landing doesn't necessarily mean the stock market's going to go up. In fact, inflation is going to rip, right, if you get a soft landing. So you're damned if you do and you're damned if you don't. But if you're going to call out and you're going to say that if inflation goes up, you're going to cut rates, and then you don't cut them, and then you're also, you have a number of different Fed governors from different states becoming more and more dovish. These guys don't know their ass from a hole in the ground. It's unbelievable. They have no idea what they've run themselves into, how they're going to get out of it. And forget about the fiscal policy. That's an absolute disaster waiting to happen. They don't know. I mean, it's pretty sad.
But that's why I'm so nervous about that funding price I alluded to. If and when they're losing control of the bond market, it is game over.
Yeah.
At that point, good luck. You can't own stocks, you can't own bonds. The currency is going to become suspect. Inflation is going to go parabolic. I mean, there's really, when you are this indebted in a nation and worldwide with out of control interest rates, it's blotto. It's over. But anyway, I digress. Go ahead, Michael.
Well, at this point, we kind of wrapped up what we had planned. We did get a couple other client questions that were sent on in, which we touched on, and I'm definitely going to reiterate those. But at the time, I just want to open it up to anybody. Utilize that chat feature if you want to take yourself off of mute for a second here, ask a question. We're all ears. But while you guys are thinking about that, one of the questions that came in that I'll just reiterate, it's asking, why are we buying so many treasuries or treasury equivalent investments? John touched on that right at the beginning. What we're really seeing in the market right now and with the data, it's all risk and there's really little return opportunities on out there. So for the time being, once things are as risky and hopefully going to settle here in the next 6-9 year, whatever time frame that it might look like, why wouldn't we take the risk off the table? Why wouldn't we put your hard-earned money into something that is yielding a 5.5% coupon rate? That's just a return in your pocket for the time being. So that's kind of the main reason why we're trying to take as much risk off the table, but still find those returns, on out there for you guys. Let's see here. I don't have anybody want to take yourself off mute? I'll open that up for a couple seconds here, or if not, we can kind of keep going. All right. So it looks like, why don't we touch on one more here? There's one other kind of question. It was kind of an interesting one. Kind of reiterates back to why we're in treasuries, but it's asking, what are potential long positions or positions that we want to buy? Do we see in the market? So what long opportunities are out there? Potentially something, what we just saw over this weekend with the war that just occurred. Kind of alongside, once again, kind of reiterating a few points. We do have a little bit long oil exposure. That's kind of really to hedge against the inflation aspect. Oil does very well when inflation is increasing. We are looking maybe in that uranium, nuclear type of investments, some defense clearly if there's a war imminent, if the U.S. is going to get put in there. But once again, it's the risk is too high. That's why we're going to keep our U.S. dollars, keep our treasuries. When long positions come up, our signaling process that we utilize with HedgeEye, it's going to flag that for us, and we're just going to weigh the pros and cons on if it makes sense to allocate that for your guys's, each portfolios at the end of the day.
Now, Mike, just as an aside on oil, don't be surprised if you have no oil in the next few days. The volatility indicator that thing's approaching 40, and when oil gets that, when the volatility for that particular asset class gets to 40, we typically get the hell out because it's becoming uninvestable. No different than when the S&P volatility hits 30 and things crash. We don't want to be there. So we've already massively reduced our oil. There's a chance we may be out of it. And another opportunity too is going to be gold. At some point, you're going to want to own a lot of it. We're at zero now. We may even short it, but Fast forward 3-6 months, and don't be surprised if you own 10-15% in gold and related equities.
Well, I think that's a good wrapping point then at this point. I think we covered quite a bit, kind of reiterating those major points. The data's worse and getting worse. We're taking kind of that sideline approach to take risk off the table and make sure that you guys are getting some type of returns, in the form of treasuries or treasury equivalent. But that being said, we are here as always. If anything does come up between now and our next quarterly call, you have our phone numbers, you have our emails. Please don't hesitate to reach on out. And with that, thank you for joining our Q4 2023 market update call.
Thanks, guys.
Thanks.